Hi, and welcome to this week's Symax Fintech Clean Report. Again, just an overview, a bit of macro, and plenty of analysis as well. Hope you enjoy it and find it useful for this coming week. First of all, our disclaimer: trading involves the risk of loss of capital. It's not suitable for everyone, and as I say every week, but I hope it is for you. As many companies provide leverage, just be careful because you can lose substantially more than your initial investment. The views, opinions, all the other information contained in this are provided solely for educational purposes. It is not investment advice. We are not encouraging you to trade or invest. That has to be your decision. You should carefully consider the risks that are involved, your financial situation, level of experience, and of course your risk appetite. Most importantly, you should only risk capital that you are prepared, but more importantly, you can afford to lose. If you've got any doubts whatsoever, seek independent financial advice, and please do that before you use your capital. Okay, so a really sort of active week last week, so much going on from the central banks. And you know, the beginning of the week was just a continuation after the previous Friday's CPI and consumer sentiment. It sort of really set the market tone for the week. And of course, it became a bearish week for stocks, and it officially went into bear trend. First time for over a decade that the stock markets have gone into an official bear trend. Of course, there was plenty of central bank meetings. You know, we had the Fed, they hiked rates 75 basis points. That's the most since 1994. It puts them on sort of about 1.75% now, and they've already warned there's lots more to come. Bank of England were more conservative. They only did 25 basis points. The UK economy is not that strong at the moment. And Swiss National Bank, they were a real big surprise. They sort of hiked rates 50 points, so they went from negative 0.75 to negative 0.25. And you know, again, you know, maybe by the end of this year they'll be back to zero or even positive again. No surprise really from Japan though. They pretty much stayed the same as unchanged. Of course, we had the ECB that came out with a specially arranged meeting on Wednesday as well. So, you know, investors and traders were concerned about that, wondering what they was going to come out with. But it turned out to be really just discussing bond fragmentation across the bloc, because Italy and a few of the others have started to cause the yields to go higher, which is a bit of a concern. You know, it's certainly not one rate for all, that's for sure. And of course, you know, we are continuing to see those interest rate rises. Bitcoin crashed again. Sunday, it went below 18,000. And oil dropped over the sort of mid to the end of the week and closed above 106, but it did trade in the 106s at one stage on Friday. So, yeah, so there's been a lot going on, you know, and where the central banks are going to keep going. You know, probably the ones that aren't going to keep going are going to be sort of China, Russia, for sure, Japan, because you know that's still adding stimulus at the moment. But let's take a look at the data this week. So for the EU, we've got consumer confidence, PMI, manufacturing, and German IFO. So that's definitely worth keeping an eye on. You know, it's going to again sort of give you an overview of perhaps where the European economies are going. For US, there's not too much out. I mean, Michigan sentiment is going to be an important one to keep an eye on. And home sales, but you know, you would expect home sales to start to decrease with rates going up. I mean, mortgage rates in the US, from what I gather, are over 6% now already. In the UK, we've got some good stuff coming out. CPI, again, inflationary data, PMI, so we're going to be looking at sort of what the purchasing managers are doing. Are they accumulating stock? Are they going to be left with that stock later on? And retail sales. How's the high streets doing? In Japan, CPI, and Norway has a meeting this week from their central bank, and again expect another rate hike there. So when we look at inflation, shrinkflation, stagflation, recession, it's all there. It's all coming if it's not here already. Inflation, we've certainly got absolute loads of. Uh, is it going to stop or is it going to keep going? We're going to have to wait and see. Shrinkflation, just when you're getting less for your money, that's certainly going on as well. And it's going to lead to stagflation in some economies and recessions into others. Not possibly until next year, so that it's not as if it's around the corner next week or something. But it just looks as though the writing on the wall that this is going to happen. There are still supply chain issues. China unlocks a little, then locks back up again. They're still sort of yearning for those zero COVID cases, which they're not managing to do yet. And of course, that Russian invasion of Ukraine's in its fourth month. Uh, Not much progress. It's sort of almost gridlocked at the moment, I would say. Energy and food prices still on the rise. Can't see any end to that just for the moment. And of course, part of that is lack of workers, so there's still those earning pressures in the markets at the moment. Now, household wealth has been reduced. It grew dramatically over COVID because people couldn't really spend, but they were still earning, especially in America. But of course, that's all changed now, and higher prices the way they are, with the stock markets coming off, potentially house prices next. People are actually losing on paper those high valuations that they had. They felt comfortable with what they could see on paper, but of course, unless you take those profits, it doesn't count for anything. And of course, as I mentioned, some countries will be heading for stagflation or recession in or around 2023. And could the next housing bubble be closed? People can't afford to move. People can't afford to perhaps even continue in the house they're in if the rates keep going up. It's going to cause some issues. Is it going to cause a housing bubble? Hopefully not, but just keep your mind on that. Trading tip of the week. It's about a trading plan. Now, I don't know, how far you guys are along at the moment with your trading. So it's, to become a consistently profitable trader requires, first of all, a robust trading strategy. Whatever you're going to be your trigger to enter and exit your positions and where to place your stop losses. But it's also a trading plan. Now, when it comes, first of all, to practicing, make sure you do it in demo mode to hone those trading skills. Backtest any strategies you've got before you risk your capital. You can come to us for advice. You can come to us for courses to help you, workshops. We provide everything at Symax Fintech. Now, the trading plan for me is a set of rules. The idea of these is to help to keep you safe and to create that consistency. Two parts to a trading plan: the financial rules, and the second part are the trading rules. Again, if you need any sort of guidance on that, please feel free to reach out to us. We're more than pleased to help you. Moving on, as usual, to the technical analysis part now. So the Dow Jones, again, stocks are now in that bearish trend. There's a gap above the market at 31,284, support at 29,553, which is from sort of late December and February. Plus, there was the previous higher from February 2020. So I'll just put that in. They sort of lock in at the same price at the moment. So that support, can be easily broken though at the moment just because of the way the markets are trending, which is down. And now is the time to start to add on your Fibonacci levels, guys, because with these markets dropping, some are either there or gone through the first one or two levels of Fibonacci already. Just make sure you get the right start point to do that. I've added some fibs on just to give you an idea anyway, but not on every. So here's the Dow 30-minute. So again, sort of identified some resistance on Friday. It sort of just ranged pretty much between the pivot point and S1. Uh, and I've managed to sort of identify a support level there. But again, this week's going to be probably another week to be careful, especially if you're looking to buy dips. With the S&P, we sort of, again, all the stocks are pretty much in the same sort of trends as looking at them, so there's not much difference between these ones at the moment. Again, identified where the resistance is going to be, and of course where the support's going to be as well. So yeah, so just remember the blue line is where the trend line is broken. It's just to sort of lock in that price. So that's what that blue price is. That's where that would be on that downtrend line, the support line. And again, there's another support below. And again, as I mentioned, I put in a resistance level as well, which is the horizontal line. So here's an example here of the S&P daily. I've added the Fibonacci levels to that. I've sort of locked the prices in on the right hand side. So, but look to the very far left and you can see which Fibonacci levels they are. So it's broken through the first one at the moment. It hasn't sort of got down to test the 50 yet. But let's wait and see. Just remember with all these lines, a support line is exactly that while the market's above it. Once it goes below it and establishes itself below, then it sort of changes its value. It then becomes a resistance line. So, just remember that for when we're going forward. And keep a note of these levels because they don't change. The fib levels, that is, they remain the same as long as obviously you keep the same low and high that you've used to calculate. Here's the S&P 30-minute. So the S&P, again, there's not too much going on. On Friday, it sort of got a little bit sticky around the pivot point level. It didn't want to move too far. It's going to wait probably for a bit more guidance this week on where it should be going. So the Nasdaq, with the Nasdaq again, we're starting to see following the rest. However, this time, we're seeing a little bit more possibly support in there than the other stocks for the moment. Again, it's tech stocks. So is that going to continue or not? They're not going to not follow the other stocks. That make, the pace of them might just change slightly. So this is the 30-minute with the pivot points on. Again, you can see how sticky it was, especially towards the late end of the session, just holding around that pivot point level and closing a little bit below. Again, the levels are there. Just remember, Monday you get a new set of pivot point levels. You get a new set of pivot point